Okay, so what does the financial system do then? We know it handles and deals with money. More importantly, it deals with rechanneling and refunneling that money back into the circular flow. So here's a pretty frightening looking image of the circular flow. It's a little bit more complex looking than the one Mr. Clifford went through, right? But it's the same thing. You've got product markets and you've got resource markets and you've got households, government, business, all doing the same thing that he talked about in his video on the circular flow, with one exception. The leakages that I've talked about before are in blue. So taxes, money spent on imports that we give to foreigners, right? We give that money to foreigners, and savings. So as you can see, when businesses make revenue, profit, and they don't spend it, that's savings. When households make income and they don't spend it, that's savings. What if there's no financial system? Where do the savings go? In the ground? In your mattress? Where do they go? Well, if there's no financial system, they don't go anywhere. They stay in a safe. They literally do go in your ground or under your mattress. In the old days, rich noblemen would keep it in a safe in their manor or estate or castle or whatever, right? Which means it was, one, out of the circular flow, two, not being spent, and even more importantly, three, not available for someone else to spend. But by creating a financial system, all that, assuming people had confidence in it, right? Once it gained acceptance, i.e., banks gained acceptance, people would put their money there for safekeeping. But that did more than just protect people's money. That was the initial story. What it did was it pooled everybody's savings together and made those large chunks of money available for others to borrow all at once. And of course, no one borrows money to put it on their table and look at it. Well, maybe for a day. They spend it. Borrowed money is borrowed so it can be spent. So when you can pool money together, it can then be borrowed and spent and channeled and funneled back in to the circular flow. So the financial system, and believe you me, this sounds absurd, but banking is a revolutionary idea of just the last couple centuries, right? Part of the reason you were able to have the Industrial Revolution is because you had the financial revolution first. You had banking first because you needed it. The huge capital required for the factories and machinery that were built during that period of time and the railways cost huge sums of money. Without a financial system in place, you never would have been able to borrow that money. You never would have been able to find it. It would never have been in one place to find. So your standard of living was dependent on first the financial system being invented as we know it today. So, in a nutshell, a financial system injects funds, saved funds that have been pulled out, so leakages that have been pulled out of the circular flow back in. And it does that in several ways. One, first, it's a place where all those savings can be pooled together and available, right? For two, the lending out of those funds or the borrowing of those funds by others, right? Which of course is then spent. Three, that spending is usually the spending that matters most. Consumer spending, not so much. It's just consumer spending, right? That keeps the economy going. But economic growth comes from investment in new capital, which is usually expensive. Technology, robotics, factories. That's still probably going to be from borrowing. Big corporations or businesses will go borrow money and then spend it just as a consumer would, except that spending, which is called investment, is what eventually leads to a greater stock of capital equipment, which then leads to greater economic potential, right, for your GDP, a larger potential GDP, right? Lastly, some of that investment is raised from borrowing. Some of it is from selling ownership, like selling stocks for the first time when a corporation sells its shares to raise funds. That's a different way. But it still injects that savings from investors back into the circular flow, right? The corporations take that money and then spend it on expansion, right? And that financial system, which is in a broader sense, includes banks, mortgage companies, trust companies, capital markets like stock markets, bond markets, investment banks, all of those things, insurance companies that take the risk out of business, stock exchanges that allow you to sell what you own so you're not stuck with it, right? I always tell my students, imagine if you had to marry the first person you ever kissed. That would change who you kiss, right? You'd think about that long and hard first, right? Exactly. So what if you bought a stock and you were stuck with it forever? Would you do it? Probably not. So how would businesses raise money? Same thing with borrowing. Stock markets or secondary markets, the ones you've heard of, allow people who have bought these things to get rid of them if they change their mind. That makes people more likely to lend out or give out or invest in the first place, which just facilitates, right, the financial system working to inject those pooled savings, those leakages, back into the circular flow. So what I want you to do now is I want you to try and understand the significance of the financial system and all that it does by watching what happened when it broke down and stopped working, or nearly stopped working, right? Much of the last recession was triggered by what's called an asset bubble from too much easy money, too much lenient monetary policy, money supply growing too quickly, which led to inflated housing prices in the United States. But because those homes and their value and the mortgages tied to them found their way into other financial products so extensively, when that bubble burst, the problem spread. And that caused the financial system to collapse. And it's that caused the Great Recession, really. That's what it was. More than anything else. That was the shock that really took everybody's breath away, everybody's economic breath away. So first, watch the crisis of credit so that you know what the mortgage crisis kind of was. Then watch the documentary so that you can understand why a financial system is so important by learning how bad it was when it stopped working.